with volunteers trained on retirement-specific issues, including pension income, Social Security taxation, required minimum distributions, the senior bonus deduction, and IRS. Both programs operate at community centers, libraries, senior centers, and churches from January through April. You can find your nearest location at the IRS website. Dorothy's return is straightforward enough that a TCE volunteer could prepare it in 30 minutes. $300 a year saved. Over 10 years, $3,000. For one phone call and a Saturday morning. Let me add it up. Bill 1, the Pennsylvania property tax rebate Dorothy never applied for. $1,140 retroactive. Bill 2, the estimated tax penalty waiver Dorothy did not file. $400. Bill 3, the Pennsylvania retirement income exclusion Dorothy's preparer missed. $2,946 over 3 years. Bill 4, the IRMAA surcharge Dorothy does not owe, but $1,140 per year for retirees in that situation. Bill 5, the tax prep fee. $300 per year, saved permanently going forward. For Dorothy, the immediate recovery is $4,486. Money that was always hers. Money the Commonwealth, the IRS, and a national tax chain were collecting from her because nobody told her to push back. $4,486 that goes back into the account she will need for cataract surgery, for the next 10 years of test strips, for the home repairs Frank had on his list before her husband passed in 2023, the year she retired, plus $4,000 more in ongoing annual savings between the recurring rebate, the recurring exemption, and the elimination of the $300 prep fee. Over the next 10 years of her retirement, $14,000 stays in Dorothy's bank account instead of in offices that were never legally entitled to it. Here is what Dorothy did. 5 calls, 1 week. Monday, she called her county and applied for the property tax and rent rebate program, including the retroactive claim. Tuesday, she called her tax preparer and filed Form 2210 on an amended federal return. Wednesday, she filed amended Pennsylvania returns for all 3 years claiming the retirement income exclusion. Thursday, she located the nearest TCE program and scheduled her January appointment for the upcoming season. Friday, she called her IRA custodian and adjusted her withholding from the default 10% to 15%. 5 calls, 5 days, 2.5 hours of total phone time. $4,486 recovered. $4,000 more saved every year going forward. Last question, and this is the one that decides whether this video changes something or just gets watched and forgotten. Type the number of the bill you are stopping first, 1, 2, 3, 4, or 5, or type all if you intend to work through every one of them this week. I read everyone. That number tells me which bill needs the deepest follow-up video, and it tells me who in this audience is moving from watching to acting. The exemptions exist, the forms exist, the phone numbers exist. None of this is a loophole. None of it is new. The property tax and rent rebate program is over 50 years old. The estimated tax penalty waiver has been in the code since 1998. Pennsylvania's retirement income exemption has been law for decades. The SSA 44 form has been available since IRMAA was created in 2007. The VITA program started in 1969. TCE started in 1978. Every one of these has been waiting for years. The only thing missing has been somebody asking for them. Dorothy spent 2.5 hours this week recovering money that should never have left her account. You can do the same. 5 calls, 5 days, the forms exist. The only thing missing is somebody asking. Be the one who asks. Tap the like button so another retiree sees this before another month of overpayment goes by. Subscribe, because the next video walks through the 3 Medicare savings programs that quietly reduce or eliminate your Part B premium entirely if you qualify, and most seniors who qualify never apply. I will see you in the next one. Dorothy is 68, retired public school teacher in Pennsylvania, 31 years in the classroom. 3 years ago, she paid off the mortgage on the 3-bedroom ranch she has lived in since 1997. She drives a 12-year-old car. She files her taxes every April with the same preparer at a national chain who charges her $300. She has never been audited. She has never missed a payment. She believes her financial life is in perfect order. Tonight she is sitting at her kitchen table with 3 pieces of paper in front of her. Her property tax notice for the quarter, her Medicare Part B statement, and the federal tax return she filed in April. She is not looking at them because something has gone wrong. She is looking at them because someone finally told her to. And what she is starting to understand is that for the last 3 years, $4,486 has quietly left her bank account in payments she did not legally owe. Money that was supposed to last her through the cataract surgery her ophthalmologist has been recommending. Money that was supposed to cover her diabetes test strips, which are no longer fully covered by her Medicare Advantage plan. Money the Pennsylvania Department of Revenue, the IRS, and her county were perfectly happy to keep collecting because Dorothy did not know to ask them to stop. There are 5 bills sitting on retirees' kitchen tables right now that you do not legally have to pay. Not partially exempt, not exempt under conditions, legally exempt. The exemptions exist. They are written into federal law, state law, or county rules. Some take one phone call, some take a single form. All of them put money back into your bank account starting this month. And the only reason you are still paying them is that nobody told you they exist. Today, I am walking you through all 5, using Dorothy's exact situation, with the exact dollar amount, exact form, and exact phone call for each one. Bill number 1, your property tax. Pennsylvania has a program called the Property Tax and Rent Rebate Program. It was expanded recently. The maximum rebate is now $1,000 per year. The income limit is $48,110, and importantly, only 1/2 of your Social Security counts toward that limit. Dorothy's Social Security is $22,000. Half of that, $11,000, plus her pension and IRA, puts her qualifying income inside the eligible range. At her income tier, the rebate she qualifies for is $380 per year. She has been eligible since she turned 65 3 years ago. She has never applied. Pennsylvania allows retroactive claims, so she can file for all 3 years now. $1,140 in checks that should have arrived but never did, because Dorothy was not enrolled in a program nobody told her to enroll in. And here is the part that applies to every retiree watching this, regardless of where you live. Almost every state in America has some form of property tax relief for senior homeowners. Texas has senior homestead exemptions that can save $3,000 to $5,000 a year. Florida has Homestead combined with Save Our Homes, which caps assessment increases at 3% annually. Georgia has full school district exemption for seniors over 62, which can cut your bill by 40 to 50%. New York has the Enhanced Star program. Illinois has the Senior Assessment Freeze. Every state has a version of this. In almost every state you have to apply. The county does not enroll you automatically when you turn 65. They are perfectly happy to keep collecting the full amount. So right now, pause this video and do one thing. Look up your county property tax program for seniors. Most counties have a web page. Type found in the comments if your county has a senior program. Type none if your county doesn't. I want to see this mapped. And tap the like button so this reaches another retiree before another year of overpayment goes by. Bill number 2. The estimated tax underpayment penalty the IRS will waive but never tells you about. When Dorothy retired 3 years ago, her income structure changed overnight. No more paycheck, no more automatic withholding. Instead, Social Security, a pension, and an IRA. Social Security withholds nothing unless you specifically request it. The IRA defaults to 10% federal withholding regardless of your actual bracket. The pension withholds based on a form she signed on her last day of work, possibly under stress. In her first year of retirement, the total withholding from all 3 sources did not cover her actual tax bill. She owed $5,000 more than had been withheld, and the IRS charged her an underpayment penalty of approximately $400. Not because she cheated, not because she lied, because the system that handled her withholding automatically for 31 years stopped working the day she retired, and nobody explained what was supposed to replace it. $400 in penalties on money that was already hers. Enough to cover a week's worth of groceries. Here is what Dorothy did not know. The IRS has a waiver specifically for new retirees. If you are 62 or older, you retired in the current or preceding tax year, and you had reasonable cause for underpaying, the IRS can waive the penalty entirely. You file Form 2210 with your return and check the box for the retirement waiver. One form, one box, the penalty disappears. Dorothy's preparer did not file Form 2210 because Dorothy did not know to ask. She paid $400. She has 3 years to amend the return and get it back. and the safe harbor rule protects you going forward. If your total withholding covers 100% of last year's total tax, you cannot be penalized regardless of what you owe this year. The fix is to call Social Security and request Form W-4V to set withholding at 12 or 22% on your benefits, then contact your IRA custodian and increase withholding from the default 10% to match your actual bracket. Once the safe harbor is met, the quarterly estimated payment system disappears as a stress point in your life forever. Bill number 3. The state income tax Dorothy paid on retirement income Pennsylvania does not tax. This one is the largest single overpayment on Dorothy's list, and it is the one that makes retirees the angriest because the mistake is so avoidable. Pennsylvania has a flat state income tax rate of 3.07%, but Pennsylvania completely exempts all retirement income from state income tax once you reach retirement age. All of it. Pensions, IRA distributions, 401k withdrawals, Social Security. Every dollar of retirement income is tax-free at the state level in Pennsylvania. It has been the law for years. It is not a loophole. It is not new. It is plainly written into Pennsylvania tax code. Dorothy's pension is $18,000. Her IRA withdrawals are $12,000. That is $32,000 of retirement income Pennsylvania does not tax. But Dorothy's preparer, who works at a national chain handling returns from multiple states, did not select the Pennsylvania retirement income exclusion when filing her state return. The exclusion line was left blank. Dorothy paid Pennsylvania state income tax of $982 per year on income the Commonwealth never legally asked her to pay. 3 years, $2,946. The single largest amount on her overpayment list. She can file amended state returns for all 3 years and recover every penny. And Pennsylvania is not the only state where this happens. Illinois exempts all retirement income despite a 4.95% rate. Mississippi exempts all retirement income. Iowa recently phased in a full exemption for residents 55 and older. New York allows a $20,000 per person exclusion. New Jersey excludes up to $100,000 for married couples 62 and older with income under $150,000. If you live in any of these states and your state return shows 0 on the retirement exclusion line, you are overpaying every year on income your state has no legal right to tax. Tell me where you live in the comments. Type your state name plus yes or no. Yes if your state exempts retirement income. No if it does not. I want to map this audience. It tells me which state to deep dive next, and it tells you which neighbors may be quietly overpaying alongside you. Bill number 4. The Medicare surcharge based on income you no longer earn. Medicare adds a surcharge called IRMAA to your Part B and Part D premiums when your income exceeds certain thresholds. For 2026, the threshold is $109,000 for a single filer. The standard Part B premium is $202.90 per month. Dorothy's income is well below the threshold, so IRMAA does not apply to her. But it applies to a specific group of retirees who need to hear this, and if you are in that group, this is the largest single bill on this list. Medicare uses your income from 2 years ago to calculate the surcharge. So your 2026 premium is based on your 2024 tax return. If you were still working in 2024, earning over $109,000, but you retired in 2025 or 2026, and your income dropped significantly, you are paying a surcharge based on a job you no longer have. The surcharge can be $90 to $100 a month combined on Part B and Part D. Over a year, that is over $1,100 in extra Medicare premiums for income you do not earn anymore. The fix is Form SSA 44. Retirement qualifies as a life-changing event. You fill out the form, attach a letter from your former employer confirming your last day of work, and submit it to your local Social Security office. If approved, Medicare recalculates your premiums using your current income. The surcharge drops or disappears. And for months you already overpaid, you may receive a retroactive credit. Bill number 5, your tax preparation fee. This is the smallest item on Dorothy's list, but it is the easiest one to eliminate because the alternative is completely free and run by the IRS itself. The average cost of professional tax preparation for a retiree is between $200 and $400 per year. Dorothy pays $300 for a return with Social Security, a pension, an IRA withdrawal, and the standard deduction. The IRS operates 2 programs designed specifically for this. The first is VITA, Volunteer Income Tax Assistance, for taxpayers with income generally under $67,000. The second is TCE, Tax Counseling for the Elderly, specifically for taxpayers 60 and older.